we're at record highs now. Is the market likely to keep moving higher from here? And what's the catalyst that pushes it?
Yeah, Tyler, I think the number one catalyst is the ongoing expansion. So long as this economic expansion continues, so long as corporations continue to make money, more money, year after year after year, that should eventually lead to higher numbers for every single stock market and higher highs as we go along. Now, when we're talking about it on a more near-term basis like this week, we have a couple of things that are backing that up. We have some decent earnings reports. We have a Fed that is providing stimulus. And we have what on the surface appears, and maybe I'm a little bit skeptical as to whether it'll ultimately turn out to be correct or not. On the surface, it appears that some of the trade tensions are loosening and we're getting closer and closer to actual trade deals put in place. So that's enough sentiment to buoy this market upward in what appears to be an ongoing expansion.
All right, I turn to CNBC investor Ron Insana.
I have a 5% stake. I should disclose.
What say you? I mean, the market's basically been stuck in a range for 18 months.
Even longer. I mean, January of 18.
January of 18.
20,
so,
22
20
months,
I guess. But it's been flirting with all-time highs here.
And we've touched them and gone above them, on several different occasions in the last 20 months or so. I still think that we're going to stay this way for a while. I mean, there was a movie once, you may remember this, Don't Raise the Bridge, Lower the River. That's what we've been doing with earnings now every single quarter. So it's getting easier and easier to cross when expectations keep falling and they're being cut again for 2020. So as long as that's a factor, I mean, sure, stocks can, perform better against weakened expectations. The trade deal, and I share Jason's skepticism that it's going to happen the way the president described it. And a Fed rate cut is probably priced in. So I think we're stuck in this range. And it's still, a question of
it's
what do you own.
It's a good range to be in.
It's not bad.
It's not bad. It's better than a 20%
3 to 5%,
decline.
one way or the other. Yeah, it's not a big deal.
Jason, you're pretty defensively positioned yourself, neutral equities, underweight bonds, but overweight cash and alternatives. Why?
Well, I mean, the neutral equities for us, that's just a recognition of where we are in the cycle. We're in the 10th, 11th year of this expansion. We are starting to see some chinks in the armor of the economy and profits, and therefore we don't want to be over the skis equity investment-wise. The cash and bonds difference, that's basically taking money away from low-yielding bonds where you have duration that could swing the wrong direction on you. And putting in more of a safe harbor in terms of cash and alternative investments from a perspective of generating that similar sort of level of return, maybe even a little bit more without that sort of risk of fluctuations.
Is this your highest level of cash in a while? I mean, can you sort of give me a qualitative assessment of where you stand on cash?
So I wouldn't say that it's the highest level of cash that we've had in a while. We're overweight both cash and alternatives effectively. So it's not actually that dramatic of a position yet. We could take that far more dramatically, but we aren't doing that at this point in time, mainly due to the fact that rates could actually and are likely to remain low for probably a fairly long period of time. And it's basically a rate differential play that we're playing on a near-term basis.